Hey there, everybody. Thomas Wood with Basecamp Trading. It is Monday, July 17th, and today we're going to talk about how to make $1 million in trading and how you do this, and some of the misconceptions that people have about trading. So we're continuing on with that mistakes traders make series, basically, but we're going on the opposite side of it. Instead of how to lose $1 million, this is how to make $1 million trading. So one thing that I always tell traders, and always tell new people, especially when they're coming in and they're starting to learn how to trade, one mistake that a lot of people make is they overestimate what they can do in a year, but they underestimate what they can do in 5 or 6 or 7 years. And traders get in too much of a hurry to go quickly make $1 million and go quickly make as much money as they can. So they end up doing things like over trading. Okay, and what I mean by overtrading is they're trading too large, using too much leverage, or they're trading too many bad setups, not trading the good setups, and they're not sticking to their rules, and they're kind of swinging for the fences, trying to hit the home run every single time they place a trade. And the problem with this is you get a very inconsistent equity curve, because all it takes is 1 or 2 times for you to mess up, and then all of a sudden you have a huge drawdown going on. Where, in my opinion, and the way that we teach people to trade, is it's much better to go for that consistency and try to minimize the drawdowns by hedging yourself and using hedge trades, things like pairs or spreads, or doing directionally weighted trades with a hedge in a correlated market type of thing. But smooth out that equity curve and just go for longevity and consistency and minimize the drawdowns. And then over time, you'll make more money, and you avoid the high probability risk of blowing up your account because you're over trading. So this is my equity curve so far this year. It's actually a little bit better than this. It's gone on up a little bit more, but you can see it's pretty consistent. Now, I'm not sitting here telling you that we never lose or anything. Yes, you'll have losing trades. Yes, you'll have drawdowns. They happen. It's a part of trading. However, we can do things and take steps to minimize those retracements, those drawdowns, and to maximize the speed at which we get back to the new high water mark. Now, along the lines of overtrading and people being in too big of a hurry and not having the patience to actually wait for the right setups and trade for a long period of time, there's an example I always like to give that shows compound interest. And what it is you ask a question: would you rather have $1 million right now, or a penny a day doubled for 30 days? A penny, start off with a penny, doubling every day for 30 days. And most people think short term. They go, well, I'd take $1 million right now instead of starting with a penny. But if you actually take a penny and you double it every single day for 30 days, I love this example because here you go. This is what it breaks down to. This is 30 days of doubling a penny. It starts off at a penny, and you don't really make all that much money. I mean, by the time you're halfway through, you're at about $600. However, look at what happens when you start really growing that account. Once your account starts getting bigger, then you start seeing these numbers really jump. In the last 3 or 4 days that you're doubling that account, you're looking at 1.3 million, 2.6 million, and you end up with 5.368 million. Okay, which beats the pants off of $1 million a day, or beats your pants off of $1 million right now. But all you had to do to get that is you have to be more patient. In that example, that just shows the power of compound interest. There's one guy I worked with. His name is Dave, and what Dave did is he started off trading a very small account, trading about a $10,000 account. Okay, and what another big mistake people make along the lines of overtrading, and something I tell traders all the time, is look, if you are trading 2 contracts, you should trade 1. Or if you think you should trade 2, you should trade 1. Or you think you should trade 4, you should trade 2. And I always tell people to go smaller than what they think they should be trading, okay? Until they get to the consistency, then they can start increasing their position sizing. But let's go back to the example of Dave. He started off with around a $10,000 trading account. And what he did when he was trading, he started off very small, trading 1 lots. And within a year, he took that $10,000 account, got it up into a 6-figure account, and he was averaging weekly returns of $3,000 plus every single week. And he got to the point where he was paying for his bills from his trading profits. So it's very doable. You can absolutely achieve that. And this is what his equity curve looks like, actually. This is Dave. This is his equity curve. You can go watch his. He's actually got a testimonial here on YouTube, on our YouTube channel, that you can go watch if you want to hear the words from him for himself. But this is what his equity curve looked like. And you see, the thing I want you to notice is drawdowns are small, retracements are small, and it's very, very consistent, which is what we're looking at when we are starting to trade. So again, main theme, most people overestimate what they're going to do short term and underestimate what they can do long term. Trade smaller than what you think you should be. So decrease your leverage. Don't be over trading. Don't be swinging for the fences trying to hit the home run with every single trade. Go for consistency go for a lot of consistent trades as opposed to going for just one big trade that's going to hit the home run for you. Okay, so that's all I have for you for today. I hope it helps. I will see you in the trading room. Don't forget to like and subscribe if you're enjoying the videos. But that's it for now. And until next time, happy trading.